Hi everyone, I'm CA Rachita Mantry. Finally, GST has come in India and various industries are in the process of absorbing this biggest indirect tax reform. Among them, one of the major industry which is going to have impact under GST is textile industry. Textile industries plays a very important role in the development of the Indian economy with respect to GDP, export promotion, employment, etc. It is one of the oldest manufacturing industry in India and also the second largest industry after agriculture, which provides skilled and unskilled employment. Textile industry is providing one of the most basic needs of people and holds importance in maintaining sustained growth for improving quality of life. It has a unique position as a self-reliant industry from the production of raw materials to the delivery of finished products with substantial value addition at each stage of processing. With potential growth opportunities in both the global and the domestic market, it has leveraged its strong manufacturing position to achieve considerable expansion. The textile and apparel industry can be broadly classified into two segments. First, yarn and fiber, natural and man-made. Second, processed fibers, ready-made garments and aprons. Textile industry has been enjoying various tax exemptions, benefits and concessions under indirect taxes. Introduction of GST could have a considerable impact on textile industry. Under current indirect taxation system, textile products are mostly exempted or are taxed at a very low rate. Most of the states in India have exempted textiles and fabrics from the levy of VAT sales tax. The excise duty exemption option was also provided by notification number 30/2004 with the condition of non-availment of SENVET credit. There was also an option to pay concessional rate of excise duty with SENVET credit benefit. However, almost all assessees opted for exemption. In 2011, mandatory excise duty was reintroduced on branded garments with SENVET credit benefit and abatement of 55% for duty payment. This mandatory levy was again removed in 2013. An optional scheme of paying duty with SENVET credit benefit was continued. In 2016, mandatory excise duty had been introduced again on branded ready-made garments made up of textiles falling under Central Excise Tariff heading 61, 62 and 63. The levy is attracted only when retail sale price is rupees 1000 or more and levy is only on 60% value after standard abatement of 40%. For payment of duty, a concessional rate of 2% without SENVET credit or 12.5% with SENVET credit option is applicable. Otherwise, the option of paying 6% with SENVET credit in case of garments, articles of cotton, not containing any other textile material is available. For garments of other compositions, nil rate without SENVET credit or 12.5% with SENVET credit is available. The non-cotton inputs for the garments such as thread, yarn, buttons, etc. have been subjected to the normal levy under central exercise for the past decade or so. Hence, presently, most of the garment manufacturers opt for either complete excise duty exemption or payment at 2% duty without SENVET credit benefit, as most of the raw materials do not suffer excise duty, especially in the case of cotton-based sector. On branded garments, the effective excise duty rate would be 1.2% if the manufacturer opts for 2% payment with abatement of 40% or 7.5% if the manufacturer opts for 12.5% payment with abatement of 40%. Hardly anybody would be expected to opt for the latter due to lack of credit availability. The VAT sale tax would also be paid at lower rates or at concessional rates under composition scheme as applicable in different states. Export have continued to be free from taxes all these years. We have discussed the pre-GST regime of textile industry. We shall move forward and discuss the impact that GST will have on the Indian textile industry. In GST regime, most of the indirect taxes such as central excise duty, service tax, VAT, sale tax and entry tax have got subsumed. In GST, the textile sector has been brought under the tax net where the rate structure for the textile is decided at 5% and 18% for cotton fiber and man-made synthetic fiber respectively. While silk and jute are totally exempted from the GST purview, the GST rate on apparel is also decided on a category basis, as apparels below INR 1000 will be attracting 5% GST, while those above this mark will be taxed at 12%. Man-made fiber fabric and yarn, along with dyeing and printing units and embroidery items, will attract 18% levy under the Goods and Services Tax Act. In the current taxation system, taxes which are being paid on inputs are being added to cost as the finished product are exempted from taxes and duties. In GST, textile output will be taxed and input tax credit, whether in the case of export or for domestic use, will be available, making taxation system transparent. Taxes paid on purchase and installation of capital asset and equipment can be claimed as ITC. This will encourage upgradation and expansion of the textile industries with latest improved technologies. Now, let us discuss option of tax payment job work in GST. Even in GST regime, the principal would get the option of sending inputs or capital goods for job work. Raw materials sent should be received back within 1 year and capital gain should be received within 3 years. If the goods are not received within this time limit, then supply of goods would be treated as supply for levy of GST. The processed goods could also be sent directly to customers of principal, provided job workers are registered or the details of job workers' place are added as additional place of business in principal registration certificate. Services by way of job work in relation to textile yarn other than of man-made fibers and textile fabrics are taxable at 5%. Job workers could choose GST exemption if the value of such services does not exceed Rs 20 lakh per annum. However, such option may not be feasible as it would break the input tax credit chain. GST payment option could be a better choice as GST would provide seamless credit on goods and services. This would be beneficial even for the principal manufacturers. The job worker should be made aware of such an option and its impact. There are a few transitional provisions which are applicable for incomplete transaction and also requirement of declarations to ensure credit on the closing stock. Unlike present indirect taxes, GST would be levied on supply of goods or services. Interstate stock transfers between different units of an entity would be subject to GST. However, transfers between units within the same state would not be liable unless separate GST registrations are obtained for different business verticals. This would have initial impact on cash flow. The receiving unit would be eligible for input tax credit of GST charged by the sending unit on goods sent. The level of stock to be maintained at warehouses, godowns, depot, etc. need to be decided considering this cash flow impact. Return filing all compliances including documentation would be automated in GST regime. Input credit eligibility would be subject to tax payment and return filing by supplier of input or input services. Credits and liabilities would be matched online on monthly basis with respect to the various returns to be filed. As provided in GST, return related reports released, there are 3 monthly regular returns to be filed in addition to 1 annual return followed by audit report. For distributing the credit of GST paid on common input services relating to units in multiple states, there is a separate return prescribed, that is IST return. Increase in number of returns could increase compliances cost in the form of additional time and staff recruitment. Matching may lead to smaller unorganized sector facing challenges of survival itself, as buyer would not be interested in spending too much time on sorting out issue of credit denial. GST implementation cost shift to GST regime from present indirect tax regime would have huge impact on the business. There is a need to analyze the impact on the entire business, including main functions, which would be helpful to ensure preparedness for smooth transition to GST regime. ERP systems would need customization for compliance under GST. Key personnel vendors should be trained to understand the concept, impact and compliance requirement under GST. Textile industry needs to be ready to meet this additional expenditure. Increased compliance burden, multiple registrations and return would prove to be a heavy burden for the industry as it would consume time, effort and resources. GST is a technology-driven law which would pose difficulties to small players who may find it difficult to adopt. Textile traders have been protesting against the 5% GST on fabrics, demanding a rollback. In a written reply to query in the Rajya Sabha, Mr. Jaitley clarified that the textile sector had been taxed in the past as well and that the GST rates are equal or lower than the pre-GST tax incidence. Therefore, the price of fabrics is not likely to go up. The finance minister also said that the centre had taken measures to allow taxpayers to register for the GST and that GST Seva Kendras had been set up to familiarize taxpayers with the new indirect tax regime. Hence, the impact of GST on textile industry would be substantial, involving lot of transitional issues, and industry need to gear up for implementation of GST after understanding the impact. I hope you like my video and do please subscribe to my YouTube channel. Thank you all.